The housing market is crazy right now. Home prices on the rise, mortgage rates on the decline, but can a spouse's credit hold up the process of a family getting into a home? I'm Joe Chavarria, and this is going to be another episode of the Joe Credit Show. So can a spouse's credit report hold up the chances of getting approved for a mortgage? Well, generally no, but it does depend on the mortgage type. So for example, most mortgage loans require a 580 to a 620 FICO mortgage score just to meet the score requirements and begin the pre-approval process. And to have income considered, both applicants must have qualifying credit scores. And so if a spouse's credit is below the minimum requirements, well, their income would just not be considered in the deal. But what if the spouse doesn't have an income? Well, most cases it'll be okay if the spouse is not working or doesn't have an income. However, the primary applicant must have enough income to support the entire household monthly debt obligations. So if the spouse has car payments and credit cards and student loan that is not working, the primary applicant has to make enough to support their debt as well as the spouse's debt. So if the non-purchasing spouse has bad credit and a lot of debt, it could be problematic for most loans. For government-backed loans like FHA, VA, USDA, a non-applying spouse's debt will still be considered in the debt-to-income ratio. And for these loan types, generally the mortgage lender wants to see about a 55, 57%, sometimes 58% tops debt-to-income ratio, like no more than that. That means that the mortgage company, with their new payment, principal, interest, taxes, and insurance, plus the consumer's monthly debt obligations, cannot exceed that ratio, cannot exceed 55, 57%, always going to depend on what the lender is looking for. So what kind of debt are mortgage companies looking for? Well, they'll take into account car payments, credit card minimum payments, they'll take 1% of the student loan debt balances, and 5% of non-medical collection debt. All of this is added into the debt-to-income ratio for FHA, VA, and USDA loans. Now, for non-government-backed mortgage loans, like a conventional mortgage, for example, conventional mortgage will ignore spouse's debt. And it does have a tougher debt-to-income ratio requirement to meet, right around 43%. But the cool thing is, if you have student loan debt, where under government-backed loans, 1% of the student loan debt is added into the debt-to-income ratio, with conventional mortgage, if those loans are in an income-driven repayment plan or a consolidation program where that monthly payment is lower than 1%, under conventional financing, the bank will take the lower amount and add that into the debt-to-income ratio as opposed to the 1%. What are some options to reduce the debt-to-income ratio if that's an issue, especially dealing with a spouse that isn't working? Well, one can refinance their auto loan to reduce the monthly payment and reduce the interest. That could help. Pay off credit card debt is another option. Put the student loans in an income-driven repayment plan and get a lower payment there. Settle out and have deleted non-medical collection debt over $1,000. Or call 800-786-2120 and speak to the credit agents to go over your options. That's my time today, guys. Thanks so much for tuning in. If you enjoyed today's episode, give me a big thumbs up. Any questions, drop them in the comment section below. Don't forget to subscribe. Again, I'm Joe Chavarria. This has been another episode of The Joe Credit Show.